What is Forex? Forex, which is short for foreign exchange, is the exchange of one currency for another currency at an agreed exchange price on the OTC market, and OTC stands for over the counter. Forex is the most traded market with an estimated daily turnover of 5.3 trillion per day. There are many different currency pairs, well over 100, but there are mainly 18 pairs which are traded the most because they are thought to be the most liquid out of them all. We have US dollar against Canadian dollar, US dollar against US dollar, Euro against US dollar against Swiss franc, pound against US dollar, New Zealand dollar against US dollar, Australian dollar against US dollar against Japanese yen, and as you can see it goes on, Euro against Canadian dollar and so on. One of the good things about the Forex market is that it's open 24 hours a day from Sunday evening all the way through to Friday night. However, they're closed over the weekend. So opens on Sunday evening, opens Sunday evening and closes Friday at night. Closed on Saturday, closed on Sunday but opens in the evening. Trading follows the clock. It opens on Monday morning in Wellington, New Zealand, progresses to the Asian trade out of Tokyo and Singapore, then finally moves to London and closes on Friday evening in New York. This ensures that there are multiple trading opportunities for traders in different time zones around the world. This also prevents price gapping when a price jumps from a level to another. However, there are times when volume is low, which leads to higher market spreads. Leverage. You've probably heard of it before. Foreign exchange is a leveraged product. This means that you are required to only deposit a small percentage of the full value of your position to place a Forex trade. What this means is that the potential for profit or loss is significantly higher than in traditional trading. Many different brokers offer different kinds of leverage. Leverage is a very important topic which I will be covering in upcoming videos to do with risk management. It can be very dangerous to use high leverage. Pricing. Each currency pair has a base currency and a counter currency. The base currency is the currency on the left and the counter currency is the one on the right. An example is Euro against US dollar. So Euro is the base because it's on the left, and US dollar is the counter currency because it's on the right. Forex prices move by currencies either appreciating, going up, or depreciating, going down in value. If, for example, the price of Euro against US dollar was to fall, this would indicate that the counter currency US dollar was appreciating, going up, whilst the base currency Euro was depreciating, going down. If you were to buy a currency pair, that means you believe that the base currency will strengthen against the counter currency, so you decide to long it, which is another word for buy. And if you sell it, you think the base currency will weaken against the counter currency, so you would short it, which is another word for sell. Pips. Pips stand for percentage in points. Most of the currency pairs are quoted to 5 decimal places with the change from the 4th decimal place, so 0.0001 is a pip. For example, 30 pips would be 0.0030. 100 pips would be 0.0100. Spread. The spread is the difference in the bid-ask of the currency pairs. So basically something along the lines of commission that your broker takes off you in the form of pips. What affects Forex prices? Forex prices are influenced by a multitude of different factors. Many different things, such as international trade, investment flows, economic or political conditions. When the market has high liquidity, this means that the prices are changing very rapidly and very quickly to news and short-term events which create multiple trading opportunities for traders. Some key factors that influence Forex prices are political and economic stability, monetary policy, currency intervention, and natural disasters such as earthquakes, tsunamis, and so on. There are 2 kinds of analysis, and these are the fundamental and technical analysis. Fundamental analysis. This is the examination of the underlying forces that affect the well-being of the economy, industry groups, and companies. The goal is to derive a forecast and profit from future price movements. Fundamental analysis involves the examination of financial data, management, business concept, and competition. Basically, a fundamental analysis relies on economic data to assess the present and future growth of the economy and where the market may be going. Fundamental analysis rely on reports, news to really decide and see where a potential stock or currency pair may be moving to or how it may behave. Technical analysis. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements. Technical analysis doesn't result in 100% accuracy about where the market is headed, but it helps traders anticipate what is likely to happen to the prices over time. At the end of the day, nobody knows where the market is headed. There is a 50% chance of it going up and a 50% chance of it going down. Your job as a trader is to stack probability of it heading in your direction. Technical analysis use different charts, time frames, indicators, support, resistance lines, amongst many other things to determine how a currency pair is behaving. What I like to say is look left, trade right. So see what's happened before in the past and trade accordingly. And another important thing is history always repeats itself. We've come to the end of my video. Thank you for watching. If you like this, please leave a like, comment and subscribe for weekly content.